In this video, guys, I'm going to answer the question, are ETFs better than stocks? Stay tuned. Hey guys, in this video we're going to look at, are ETFs better than stocks? Great question, because ETFs are super popular at the moment. Since there's been a new ETF for everything. We can trade anything from the S&P 500 to the VIX, to gold miners, to financial stocks, to Brazilian exposure. The list goes on. I've done videos where I've talked about different ETFs and exposure, etc, etc. So the obvious question is, well, should I be trading ETFs as opposed to stocks? Are they better than stocks? So I put together a few pros and cons, and maybe we'll touch on some few more in this video. These are my thoughts on if you're weighing up the difference between trading ETFs and stocks, kind of things you could consider. Okay, so the first thing is yes, in the yes column, number one is less legwork. In other words, we kind of, you can get exposure to a sector or an industry or a country or a commodity or an asset that you're quite interested in without doing all the due diligence and legwork to really nail it down. So if you think, okay, I'm bullish on Brazil, I can buy the Brazilian ETF. I'm bullish on volatility, you can buy volatility ETF. I'm bullish on America or interest rates or financials or this or that or the other, you can just buy them. You can buy an ETF and you'll get a broad exposure, because what they'll do is they will, allocate different parts of the ETF or different kind of chunks, different stocks, and you'll get a broad exposure. And if you want to get exposure to any industry possible, go on forever. Like I said, I've done a video exclusively on that. So you don't have to do legwork. You can just want to get exposure and you buy the ETF and let the ETF manager do everything for you. So the other thing is you get broader exposure. So that's if you do think that a whole sector or a whole country or a whole market is going to lift up, it's an easy way of kind of nailing out, saying, okay, well, I think retail is going to do really well. It's been struggling. Let me buy the retail ETF. Let me buy transportation. Let me buy, anything out there. And you can just say, okay, I want a broad exposure to that, and assume that all those companies are going to do well. And that's perhaps easier for a lot of people to do, especially if they don't have the time to perhaps pick the best stock. Maybe the stock they think is overvalued and all this kind of stuff. So you get the broader exposure by buying the ETF, generally speaking. You can potentially have more leverage, because we have double leverage ETF and triple leverage ETF. And I'm going to add on to here some flexibility as well, because if you are unable to short stocks, many people can't because of the tax wrapper they're trading them in, you can buy an inverse ETF, which will behave as if you have shorted the stock. So an inverse ETF will go up when the stock or the asset goes down. So if SPY goes down, the S&P 500 ETF goes down, and you've got an inverse of that, that will go up. And you can leverage those as well. You've got double leverage, triple leverage as well. So you can get leverage without technically using leverage, but you are, if that makes sense. So again, if you've got restriction for some kind of wrapper that you're trading it in, you can get some short side exposure and you can leverage yourself up a little bit, which you can't do generally with stocks unless you're using traditional leverage, i.e. you've got 100 grand and they give you 400 grand to trade with. There's a huge selection as well, guys. Okay, that's a pro with stocks also, but the selection is getting so big now that generally if you've got a trade thesis and it's reasonably broad, you can find an ETF to trade that for. Okay, so on the no side, you can't bet on a company / product. Seems self-explanatory, but a lot of the big returns are made by placing a bet or placing a trade, placing an investment on a specific company, like for example Apple, new in the kind of smartphone space, like Amazon, the way that people will do shopping and buy products, Netflix, the way people will consume entertainment. These are bets on a significant change. And okay, we don't have to be as broad as that, making huge company bets. You can trade companies that are completely different ways of doing business. But the point is, with an ETF, you're restricted with that, obviously, because it's a broad, generally basket of stocks. This way you can strip out and say, well, I really like that company. I really like that management. I really like what they're doing. I really like the fact they've got not a lot of debt on the balance sheet. They've got a lot of exposure. They've got a lot of growth. They've got a new fresh team on, whatever it may be. That then you can place your, place your bet. You can place your trade. You can invest. You can take some risk on that exclusively, which you can't do with an ETF, which is quite powerful. So it's harder to get alpha when you are trading an ETF, because it's so broad, it's difficult to outperform. Now, of course, they do go down into sectors, and if your sectors are outperforming the broad market, you're going to generate alpha. But alpha often is generated when people are getting more exposure to specific stocks. Stock picking on the whole generates alpha better than being broad. And if you're going a little bit more aggressive into a couple of stocks that you really think are doing well, and they do well, then you're going to generate significant alpha rather than being a few sectors that maybe one or two do well. Yes, you might outperform the benchmark that you're kind of looking at, but it's not going to be as much as if you were trading the stocks, if you get it right on the assumption. Okay, the moves are potentially limited with an ETF. So people might disagree with me on this, and of course if you're using the triple leverage, of course that's different. But if you look at ETFs, they trade a little bit more like an index. And yes, some super volatile ones out there, don't get me wrong, some really aggressive ETFs. But on the whole, they are a little bit dampened in the move as compared to some stocks. You know, from the right end of a stock, it can really rip, you know, a decent amount, 10, 20, 30%, depending on what stock you're trading. For an ETF to do that, unless it's triple leverage or a very unique one, if it's broad enough, it's not going to do that, purely because, like an index, is dampened down by all the stocks that are in it. So even one goes off, unless it's got a high weighting on it, it's still going to be kind of dampened. The move's going to be dampened by the others that are in the ETF. So that could be a pro, actually, to be fair. You know, I put it in the negative column because there's someone who likes volatility and likes getting involved in that's a bit of a downside. But if you don't, you prefer kind of a steady thing, but without having a broad market exposure, stripping out sectors, maybe that becomes a positive. And the final thing is fees. You know, as unlike stocks where you pay a commission to get in, a commission to get out, exchange fee or whatever, as you would do with an ETF, you're not charged an annual fee as you are with an ETF, because an ETF is almost, you could look at it like a little mini fund. There's some management that goes in it, some bits and pieces. So depending on what you're trading, there are some fees. A stock, you don't have those fees. Once you bought it, you can tuck it away and you're happy, apart from, of course, if you're trading on margin and you're using some leverage. All right, guys, those are some pros and cons, or yes and no, are the ETFs better than stocks, yes or no? Some ideas either side. Let me know your thoughts in the comment section below. Any on the yes column and the no column that I've missed, stick them in and I'll read them and maybe do another video. Take care, bye-bye.